This is a special report from Seafried and Brew, especially Dr. Ed, for what has happened this week.
Amazing. Can't wait to talk about it.
When we look at it, your title, the promised zero rate period.
Yes, as you know, Jay, this week is maybe the unprecedented in the history of the Federal Reserve. They actually promised to keep interest rate at zero through mid-2013. And frankly, I think keeping that promise is going to be a real challenge. And we'll talk about that.
And we just spent a good half hour doing another webcast for our quarterly subscribers to our performance risk report. And in that, we really went through strategies of how to really deal with where we are right now.
Yeah, but I'd like to share with our general audience what was behind our last webcast.
Yeah, because the big question, Dr. Ed, is what is the difference between last week and this week?
Nothing, other than Americans lost trillions of dollars of wealth from what I consider almost a criminal act by S&P. Now, S&P, as you know, in my opinion, was responsible for much of the housing bubble collapse. They missed forecasts. They told us that AAA mortgage-backed securities, subprime, were AAA. In fact, they were junk. That created a crash that wiped out trillions of dollars of wealth. And then last week, they downgraded U.S. securities. We're now on the same level as New Zealand, my God. And that wiped out trillions of dollars of wealth. So they've caused two crashes in 3 years, which says a lot about the S&P bond rating index. We've caused no crashes yet.
But along with it, the S&P National Economic Risk Index that Dr. Ed put together, what is this saying, Ed, in here?
Well, Jay, it's saying that there's been virtually no increase in threat of a recession. Yes, the numbers were a little weak. I think the July 29th GDP revision really spooked everyone because it looks more and more, Jay, that this recovery is sort of a Potemkin recovery. I call it a rattlesnake, I call it a catfish recovery. That is bottom, slow, not real exciting.
Yeah, but along with it, Ed, a lot of that GDP situation was caused by gasoline prices rising. So
absolutely, no question about it.
And now with those coming back down, I mean, it would still consider this to still be moderate. So you could argue that possibly the Dow is way oversold in here.
Absolutely.
For the risk. And of course, we've had a big change in the yield curve. Looking at 2-year dropping down to 0.17%. Looking at the 10-year in here declining down to that 2% at one point, and then in here this morning right around a 2.20, but very volatile in here.
Yeah, I mean, I would like to share with our general audience some of the things we talked about in our special subscriber report, and what we told them to look into is make sure your deposit prices are matched as closely as possible to the current Treasury yield curve. And because that's a way to really make some money for your institutions, because people expect rates to be low. They've been told by Bernanke they're going to be low for 2 years. Well, make them low. Jay, I think this graph is important. For those of you in the investment side of your bank, you may now think that long interest rates can't go any lower. And it's amazing the debates I get in when I speak to the CEOs around the country that they just feel interest rates can never go lower. Well, they dropped 50 basis points in the last 2 weeks. And I ask our analysts to prepare this slide of the most recent numbers from this morning to compare the United States interest rates on government securities for the 10-year to a country that's experiencing what we're starting to experience, Japan. Notice rates in Japan are now 1.04%. Now you might think we're comparing apples and oranges, but I'm not so sure, Jay. This is what Japan had to do to get any kind of economic growth at all in terms of lower interest rates. Notice how we are now very similar to the German and the UK interest rates. But to say that rates can't go any lower, because with Germany especially, you're talking about a relatively vibrant economy who hasn't been hit by the recession as badly as we have, whose unemployment rate isn't nearly as bad as we are, yet they are in that troubled Eurozone.
But these short-term rates, Ed, it's amazing that Germany is as high as that is.
Well, I think the reason is ours are low because we're trying to get the economy moving again. Their economy is already moving. So what should you be thinking about interest rates? My view is today the debate in your institution should be someone should become an expert on unemployment and someone should become an expert on inflation, because those are the two forces that will drive interest rates over the upcoming quarters. Now, Jay, my view is, and you know this, I think the Fed's going to have trouble keeping their promise. But there's something they can do and still keep their promise. They can, in fact, tighten the screws on the economy if inflation begins to rise, even by keeping interest rates zero. What they could do, Jay, is begin to sell off some of those securities that they hold, the $2.6 trillion they hold from QE1 and QE2. That would be de facto tightening without raising interest rates, at least short-term interest rates. But I think it would influence longer-term interest rates. That's why this period is so complex. You might think as a banker, oh, it's going to be easy. Rates are going to be fixed for 2 years. Not so. I don't think the yield curve is going to be stationary for 2 years. The short end will be because of this promise. But the long end could be all over the place. In the June FOMC meeting, we now have the minutes. And I'm dying to read the minutes from the August meeting. They'll be out in 2 weeks. But there was clearly a conflict between those who said, hey, inflation's an issue, and those who said unemployment or deflation is the issue. And as you know by the vote, Jay, 3 members of that 10 voters said inflation's a problem, and 7 said no, deflation's a problem. What's the bottom line? What do we think here at Seafried and Brew? Our view is, at least for the time being, as we enter the third quarter, the summer's winding down, the fall will be on us before we know it. Our view is that the economy's weak, that unemployment trumps inflation fears at this moment. So I would expect low rates, and QE 2.5 is what we call the current situation of reinvesting the proceeds from matured securities to keep the holdings of Fed's balance sheet constant. And I would not be surprised, would you, if we had a QE3, if the unemployment numbers are start to rise even more, we could get something else from the Fed.
Thank you, Dr. Ed. Have a good week, and we'll watch as things progress in here.
Good seeing you again.